Now speaking, Ethan Brown, Founder, President, and Chief Executive Officer. In Q1 2023, BYND Meat saw solid progress towards their sustainable growth operating model with a laser-focused margin expansion and OPEX reduction of $34 million. Inventories were reduced by $13 million, net revenues rose 15% from Q4 2022, and international food service grew 100% year-over-year. Their strategy focuses on advancing taste and sensory profile, articulating health benefits, and driving cost structure to match and underprice animal protein. They launched new generation burgers and Beyond Steak, which was certified by the American Heart Association and Good Housekeeping Institute's Nutrition Lab. They plan to implement marketing programs, collaborate with retailers, apply strategic pricing, and introduce renovations for peak grilling season. We are encouraged by the early results of our transition to sustainable growth during the second quarter. We have implemented lean value streams across our beef, pork and poultry portfolio for margin expansion and OPEX efficiency and have been managing inventory for cash. We have also narrowed our near-term growth initiatives while still supporting our long-term partners and opportunities. Our goal is to achieve a cash. Now speaking, Lubi Kutua, Chief Financial Officer and Treasurer. Our first quarter results demonstrate early success in executing against our operating plan. Net revenues declined 16% year-over-year to $92.2 million, but we drove a 15% sequential increase relative to Q4, the strongest Q4 to Q1 percentage increase since 2019. Gross profit was $6.2 million or 6.7% of net revenues compared to $0.2 million or 0.2% of net revenues in the year-ago period. Operating expenses were $63.9 million, down approximately 35% year-over-year and reflecting ongoing focus on right-sizing expense base. Net loss was $59 million or net loss per common share of 92 cents compared to $100.5 million or net loss per common share of 1.58 in the year-ago period. Adjusted EBITDA was a loss of $45.8 million or minus 49.6% of net revenues in the first quarter of 2023 compared to an adjusted EBITDA loss of $78.9 million or minus 72.1% of net revenues in the prior year. For full year 2023, we expect net revenues to be $375 to $415 million, representing a decrease of 10 to 1% compared to 2022. We expect net revenues to increase 15% sequentially in Q2, taking into consideration tough year-ago comparisons and temporary supply chain issues. Gross margin is expected to be 1 to 2 percentage points higher than previously anticipated due to change in accounting estimate for depreciation. Total operating expenses are expected to be $250 million for the full year, weighted slightly more heavily towards the front half. We target the achievement of positive free cash flow within the second half of 2023. Bernstein analyst Alexia Howard inquired, "Do you have a plan to get cash flow to positive in the second half of the year, despite pricing decreases and higher category headwinds?" Ethan Brown replied, "We have 4 levers to help us become cash flow positive and increase net revenue margin: optimizing inventory, gross margin improvement, freeing up cash from inventory, and controlling operating expenses." We achieved positive cash flow this quarter due to systemic shocks subsiding and kick improvements. We plan to accelerate this in the second half of this year, but will fluctuate as we continue to orient the business towards a cash flow positive trajectory. Our decision-making is based on achieving and maintaining cash flow post-operations. Goldman Sachs analyst Adam Samuelson inquired, "Can you provide more information on the $200 million at the market equity facility, including the intention of raising that much capital, the time frame, and how cash flow positive operations will be measured in the second half of the year?" Ethan Brown replied, "We wanted to put an ATM out there to bolster our cash reserves and provide an answer to a lingering question. We are making week-over-week progress toward restoring growth and creating a sustainable business model and will use the ATM opportunistically when conditions are appropriate." Lubi Kutua replied, "We are targeting to be cash flow positive in the second half of the year, either both quarters, Q2 and Q3, or one quarter. We are doing all we can to drive gross margin performance and manage operating expenses tightly to reach our objective. Our definition of cash flow positive is free cash flow, operating cash flow from operations less CapEx." Jefferies analyst Rob Dickerson inquired, "Have household penetration levels dropped over the past 12 months, and does the new innovation pipeline give greater confidence in consumer reaction to it?" Ethan Brown replied, "There has been a reduction in household penetration of plant-based meat from 27.8% to 25.5%. 3 main factors contributing to this are macroeconomic inflationary environment, ambiguity around health benefits and brand-specific issues of a crowded landscape. Positively, the frozen category saw units up 32% and dollars up 36%, indicating the power of BYND innovation. Later this year, renovations and new products such as BYND Steak will be released to re-engage consumers. Price parity programs are being tested to show elasticity for plant-based proteins. Revenues for Q2 are lapping a very significant quarter from last year, but Q3 and 4 have lower comps and are expected to show growth. Bank of America Merrill Lynch analyst Peter Galbo inquired, have the depreciation impacts to gross margin only affected Q1 or will they continue throughout the year? Lubi Kutuo replied, we reassess the useful life of our large equipment from a range of 5 to 10 years to a uniform 10-year lifespan, which is in line with industry standards. This has led to an increase in our gross margin guidance for the full year, by 1 to 2 percentage points. However, as our second and third quarters tend to have higher revenues due to seasonality, depreciation as a percentage of total net revenues will be lower in those quarters. Bank of America Merrill Lynch analyst Peter Galbo inquired, I would like to know why U.S. retail underperformed in comparison to the scan data, and if there is any load-in factor to be aware of regarding the positive delta in international food service for the first quarter. Ethan Brown replied, we have seen a 100% growth in international food service over the past year, driven by mom and pops and also TGCs. Despite turbulence in recent years, the transition to plant-based meat is continually progressing with increased strategic partnerships in Europe. There has been some disruption due to market noise, but pricing tactics, marketing programs and new product development are helping to drive growth in retail. Additionally, research conducted on Beyond Meat products has revealed drops in bad cholesterol and TMA compounds associated with heart disease. This is being backed up by endorsements from organizations like the American Heart Association and the American Cancer Society. Barclays analyst Ben Thur inquired, have international food services partnerships helped it return to pre-pandemic levels in Europe, with respect to outlets, volumes and cadence for the rest of the year? Ethan Brown replied, I have been working with McDonald's and Yum! In Europe, resulting in the successful launch of McNuggets and plant-based nuggets. We've seen positive press and consumer reaction to these products. Year over year, we've reduced prices for these products by 9% on average, while also maintaining a positive margin. We expect to continue rolling out these products into other markets. Pig analyst Peter Soleil inquired, can you provide any insights on the success of your product in Europe, specifically around trial and repeat purchases, as well as characteristics of the customers who are buying? Ethan Brown replied, we are contemplating expansion with various partners and leaning into categories with strong health credentials. In Europe, consumer behavior around climate change is encouraging and fast food organizations are battling it out on plant-based offerings. In the US, younger people care about climate change and we are working closely with them. BMO Capital Markets analyst Matt Linden inquired, do you think balancing price parity with near-term margin growth is a feasible strategy to ensure consumer adoption of plant-based proteins? Ethan Brown replied, we are emphasizing total profit dollars over percent margin, as part of our strategy to increase volume. We have reduced the number of co-packers from 8 to 3, while also lowering costs. We are confident that there is still hanging fruit to grab, and have seen a 9% reduction in average pricing over the course of the year. We are adopting lean methodology to eliminate waste, drive profits and create an entrepreneurial environment. Piper Sandler analyst Michael Lavery inquired, have inventory levels decreased recently and what is the outlook? Also, could you explain why you chose to bring jerky production in-house and how that process will unfold? Ethan Brown replied, we have brought jerky in-house to maintain cash flow and sustainable growth. We have grown the plant-based turkey market six-fold in 1 year and are focusing on improving margin. We have a program to monetize any excess ingredients and control aging inventory. We are increasing volumes, reducing fixed overhead absorption, collaborating throughout the supply chain, increasing equipment throughput and eliminating waste to improve our margins. Lubi Kutuo replied, we expect our total inventory levels to decrease significantly by the end of this year, as part of our goal to become cash flow positive. Our team has done a great job in reducing these levels and we will continue to do so, though it might not be an even decline. Mizuho Securities analyst John Baumgartner inquired, have you considered making a strategic pivot to get more involved in the frozen case as other premium categories in the store are doing okay right now? Is it possible that the competition from animal meat in the refrigerated aisle is much larger and entrenched than anticipated 3 or 4 years ago? Ethan Brown replied, our goal is to be a major player in the $1.4 trillion global protein market. To do this, we are not looking to make our products high-priced niche items. Our Cookout Classic product has a strong ratio relative to bubble burgers in the frozen section, and when paired with the right pricing, it could have an outsized return. We will continue to pursue success in the fresh section, though it will take longer than expected, and are taking advantage of the traction seen in frozen. Ethan Brown replied, I am confident that this business has turned a corner and will experience better growth with a reasonable margin in the second half of the year. We have already implemented changes to help us achieve this goal, and our team is optimistic about the future. We anticipate reporting positive results next quarter.